Module 15, Exchange Rates and International Finance. Exchange rates, the price of one currency expressed in terms of units of another currency. What does it mean to have a strong or weak dollar? What are the implications of fluctuations in exchange rates? An exchange rate is a price, that is, the price of one currency in terms of another currency, and so we can analyze it with tools of supply and demand. The foreign exchange market. Most countries have their own currencies, but not all. Sometimes small economies use the currency of an economically larger neighbor. Ecuador, El Salvador, Panama all use the US dollar. Dollarize means to use the US dollar as their currency. Sometimes nations share a common currency, such as the euro. The market in which people or firms use one currency to purchase another currency is called the foreign exchange market. Every exchange rate is a price, the price of one currency expressed in terms of units of another currency. The key framework for analyzing prices is supply and demand. The extraordinary size of the foreign markets. The quantities traded in foreign exchange markets are breathtaking. A survey done in April 2013 by the Bank of International Settlements found that 5.3 trillion per day was traded on the foreign exchange markets. This makes the foreign exchange market the largest market in the world economy. In contrast, in 2013, U.S. real GDP was 15.8 trillion per year. Now it's more like 20. And here is some information about most of the trading is the U.S. dollar. International supply and demand. The demand for dollars comes from U.S. export firms seeking to convert their earnings in foreign currency back into U.S. dollars. Foreign tourists converting their earnings in a foreign currency back into U.S. dollars. And foreign investors seeking to make financial investments in the U.S. economy. On the supply side of the foreign exchange market for the trading of U.S. dollars are foreign firms that have sold imports in the U.S. economy and are seeking to convert their earnings back to their home currency, U.S. tourists abroad, and U.S. investors seeking to make financial investments in foreign economies. Demanders and suppliers of currency in foreign exchange markets. Financial investments that cross international boundaries and require exchanging currency are often divided into two categories. Foreign direct investment, purchasing more than 10% of a firm or starting a new enterprise in another country. Portfolio investment, an investment in another country that is purely financial and does not involve any management responsibilities. Here's a chart that shows how an international investor who expects that in the future a British pound will buy $1.60 in the U.S. currency instead of its current exchange rate of $1.50 may hope for the following chain of events to occur. Takes 24,000 in U.S. currency, converts it to 16,000 pounds in British currency. The exchange rate for pounds changes from $1.50 to $1.60. Now converts the 16,000 pounds back to $25,000 and earns a profit of $1,000. Here's another way. An international investor who expects that in the future the British pound will buy only $1.40 in U.S. currency instead of its current exchange rate of $1.50 may hope for the following chain of events to occur. Take 20,000 pounds in British currency, convert it to 30,000 in U.S. currency. The exchange rate for the pound changes from $1.50 to $1.40. Now converts the 30,000 back to approximately pounds of 24,429 and earns profits of 1,429 pounds. Demand and supply lineups. The demand and supply lineups in the foreign exchange markets. Demand for U.S. dollar comes from a U.S. exporting firm that earned foreign currency and is trying to pay U.S.-based expenses. Foreign tourists visiting the United States. Foreign investors who wish to make direct foreign investments in the U.S. economy, and foreign investors who wish to make portfolio investments in the U.S. economy. Supply of U.S. dollars comes from a foreign firm that has sold imported goods in the United States, earned U.S. dollars, and is trying to pay expenses incurred in its home country. U.S. tourists leaving to visit other countries. U.S. investors who want to make foreign direct investments in other countries. U.S. investors who want to make portfolio investments in other countries. Participates in the exchange rate market. The foreign exchange market does not involve the ultimate suppliers and demanders of foreign exchange literally seeking each other out. The foreign exchange market works through financial institutions and it operates on several levels. Most people and firms who are exchanging a substantial quantity of currency go to a bank. Most banks provide foreign exchange as a service to customers. These banks and a few other firms known as dealers then trade the foreign exchange. This is called the interbank market. Strengthening and weakening currency. When the value of a currency rises, the exchange rate is described as appreciating or strengthening. When the value of a currency falls, the exchange rate is described as depreciating or weakening. In looking at exchange rate between two currencies, the appreciation or strengthening of one currency must mean the depreciation or weakening of the other. You can see in these two charts how that works. Strengthening and weakening continued. With the price of a typical good or service, it is clear that higher prices benefit the sellers and hurt the buyers, while lower prices benefit the buyers and hurt the sellers. In the case of exchange rates, it's useful to trace through how different participants in the market will be affected by a stronger or weaker currency. For a U.S. tourist abroad who is exchanging U.S. dollars for foreign currency as necessary, a stronger U.S. dollar is a benefit. A stronger dollar injures the prospects of a U.S. financial investor who has already invested money in another country. A stronger U.S. dollar boosts the returns of a foreign investor putting money into a U.S. investment. Here's a little table that recaps it all. It's called How Do Exchange Rate Movements Affect Each Group? If the interested party is a U.S. exporting firm, reaction to a strong U.S. dollar is negative, reaction to a weak U.S. dollar is positive. If the interested party is the foreign firm exporting to the U.S., it's positive with a strong dollar, negative with a weak dollar. U.S. tourist abroad, positive, strong dollar, negative, weak dollar. Foreign tourist in the U.S., strong dollars, negative, weak dollar, positive. U.S. investor abroad, strong dollar, negative, weak dollar, positive. Foreign investor in the U.S., positive when it's a strong dollar, negative when it's a weaker dollar. Demand and supply shifts in foreign exchange markets. The foreign exchange market involves firms, households, and investors who demand and supply currencies coming together through their banks and the key foreign exchange dealers. You can have a downward sloping demand curve and an upward sloping supply curve and find the price or exchange rate that clears the market and the quantity of the trade. Expectation about future exchange rates. One reason to demand a currency on the foreign exchange market is the belief that the value of the currency is about to increase. One reason to supply a currency is the expectation that the value of the currency is about to decline. In the foreign exchange market, supply and demand typically both move at the same time. Groups of participants in the foreign exchange market, like firms and investors, include some who are buyers and some who are sellers. An expectation of a future shift in the exchange rate affects both buyers and sellers. That is, it affects both demand and supply of a currency. Differences across countries and rates of return. The motivation for investment, whether domestic or foreign, is to earn a return. If rates of return in a country look relatively high, then that country will tend to attract funds from abroad. Conversely, if rates of return in a country look relatively low, then funds will tend to flee to other economies. Changes in the expected rate of return will shift demand and supply for a currency. Since a nation's central bank can use monetary policy to affect its interest rates, which is the return that you would earn, a central bank can also cause changes in exchange rates. Relative inflation. If a country experiences a relatively high inflation rate compared with other economies, then the buying power of its currency is eroding. This tends to discourage anyone from wanting to acquire or to hold the currency. This graph shows an example of an actual episode concerning the Mexican peso. Purchasing power parity. Arbitrage, the process of buying and selling a good or a service across borders to take advantage of international price differences. Purchasing power parity, the exchange rate that equalizes the prices of internationally traded goods across countries. One reason to demand a currency on the foreign exchange market is the belief that the value of the currency is about to increase. The purchasing power parity exchange rate has two functions. PPP exchange rates are often used for international comparison of GDP and other economic statistics. Exchange rate will often get closer and closer as time passes. Exchange rates, aggregate demand, and aggregate supply. A central bank will be concerned about the exchange rate for three reasons. 1. Movements in the exchange rate will affect the quantity of aggregate demand in an economy. It's coming from the difference between exports and imports. 2. Frequent substantial fluctuations in the exchange rate can disrupt international trade and cause problems in a nation's banking system. 3. The exchange rate may contribute to an unsustainable balance of trade and large inflows of international financial capital. Foreign trade in goods and services typically involves incurring the costs of production in one currency while receiving revenues from sales in another currency. Fluctuations in exchange rates. Exchange rates can fluctuate a great deal in the short run. One of the most economically destructive effects of exchange rate fluctuations can happen through the banking system. This process of borrowing in a foreign currency and lending in a domestic currency can work just fine as long as the exchange rate does not shift. So what if the banks borrow $1 million in US dollars and agree to pay 5% interest? Banks convert to a Thai baht at an exchange rate of 40 bahts per dollar, making 40 million baht. The banks lend 40 million baht at 6% interest. After 1 year, loan is repaid with interest, so the bank receives 42.4 million baht. The bank converts baht back to dollars at an exchange rate of 40 baht per dollar, making 1.06 million. Bank repays 1 million plus 5% interest, which is 1.05 million. Bank has 10,000 or 400,000 baht left over to cover expenses and profits. But here, what if the bank converts baht back to dollars, but now the exchange rate is 50 bahts per dollar? So the bank has only $848,000. Bank repays the 1 million loan plus 5% interest, which is 1.05 million. Bank now faces a loss. 1.05 million minus 848,000 is a loss of 202,000 because there was a different exchange rate, bahts per dollar. Exchange rate policies. Nations need to think about what exchange rate policy they should adopt. Exchange rate policies come in a range of different forms. Floating exchange rates is one extreme, and that's when it's completely determined by market forces. That's what we have. Soft exchange rate pegs. The exchange rate is usually determined by the market, but the central bank sometimes intervenes within some sort of exchange rate pegs. That's when the exchange rate is usually determined by the market, but central banks sometimes intervene. I know I already read that, sorry, but the idea is there can be a band within which the exchange rate fluctuates. Hard exchange rate pegs, central bank always intervenes in the market to keep the currency fixed at a certain level. And then there's merging currencies. The currency is made identical to currency of another nation. Floating exchange rates, a policy which allows the foreign exchange market to set rates, is referred to as a floating exchange rate. The US dollar is a floating exchange rate, as are the currencies of about 40% of the countries in the world. Movements of floating exchange rates have advantages. All prices of goods and services rise and fall throughout a market economy as demand and supply shift. Using soft pegs and hard pegs. A government intervenes in the foreign exchange market when the exchange rate of its currency is different from what the market would have produced. This establishes a peg. A soft peg is the name for an exchange rate policy where the government usually allows the exchange rate to be set by the market. If the exchange rate seems to be moving rapidly in one direction, the central bank will intervene in the market. With a hard peg exchange rate policy, the central bank sets a fixed and unchanging value of the exchange rate. A central bank can implement soft peg and hard peg policies. Trade-offs of soft pegs and hard pegs. When a country decides to alter the market exchange rate, it faces a number of trade-offs. One concern with pegged exchange rate policies is that they imply a country's monetary policy is no longer focused on controlling inflation or shortening recessions. Another issue arises when a central bank intervenes directly in the exchange rate market. A central bank that causes a large increase in the supply of money is also risking an inflationary surge in aggregate demand. Another issue is that when a government pegs its exchange rate, it may unintentionally create another reason for additional fluctuation. Merged currencies. It's a common currency shared with one or more nations. A merged currency approach eliminates foreign exchange risk altogether. A merged currency also poses problems. Merged currency means that a nation has given up altogether on domestic monetary policy and instead has put its interest rate policy in other hands. There's no consensus among economists about which exchange rate policies are best, floating, soft peg, hard peg, or merged currencies. Quick review. What is the foreign exchange market and the main groups of people or firms who participate in the market? What are the different types of investments, like foreign direct investment, portfolio investment? What is the exchange rate when a currency increases in value and a currency decreases in value? Who benefits from a stronger currency and who benefits from a weaker currency? What are the factors that cause the demand and supply of foreign currencies to shift? What is arbitrage and the importance of purchasing power parity? How do changes in exchange rates influence aggregate demand and aggregate supply? What is the difference among a floating exchange rate, a soft peg, a hard peg, and a merged currency? What are the trade-offs that come with a floating exchange rate, a soft peg, a hard peg, and a merged currency? And that is all.